Okay, good morning. Midterm on Friday, chapters 1 through 4. Had some visitors Monday and Tuesday in my office, which was good. Montisha's having a review session Thursday from 5 to 7, I believe, is the time. And she wrote the number on the board on last Friday. I think it's over. Does anybody have it handy? It's temporary building. Number 3. Thursday, thank you, 5 p.m., correct? Suggest you attend that. I think it would be very helpful just to cover up any loose ends that you might have. God forbid you're going to leave this till Thursday, but you never know. Just in case you get distracted and you haven't figured out exactly what's going on between now and Thursday evening, suggest you go to the review session. So today I'd like to finish chapter 4, and I won't start any new material before the midterm, okay? So we can perhaps go a little bit slower today or even have some time for questions. I want to talk about the Eurodollar today and the yen. I want to talk about something called an interest rate parity condition, and then a little bit about the articles I've sent you recently on the dollar and this business of Secretary Snow and George W. Bush trying to talk down the U.S. dollar. So let's refer to Eurodollars. We've already described what they are. They're deposits in foreign banks of U.S. dollars. It's the largest volume futures contract in the U.S., traded on the Chicago Mercantile Exchange. It's a short-term interest rate, basically reflects a 90-day time deposit based on the LIBOR rate in London, as I mentioned. Okay. I've emphasized the European banks, but it's also the case that you can obviously deposit U.S. dollars in other foreign banks, such in Asia, and they will also pay you something that would be very close to the LIBOR. Unlike the Treasury bond or the Treasury note, delivery is cash settled. There is no delivery on Eurodollars. Okay, there is no delivery on Eurodollars. As you know, some contracts allow for delivery, some do not. Some it's impossible to deliver on. With the Eurodollar, the contract size is $1 million. It's a 90-day time deposit or a 3-month time deposit. And as I mentioned, the quote is 100 minus the interest rate. 100 minus the interest rate equals the IMM index, which we call the Eurodollar index. So if the interest rate's 2%, then the index is 98. I give you some examples here. If the rate is 6.82%, then the index is 93.18. Okay, so 100 minus 6.82% is equal to 100 and, what did I say, 93.18. So that's the price. That's the price of the contract. It's discounted from 100, so it'll never be 100. Unlike T-bonds, it can go above 100 because they trade as a percent of par. This simply trades as the 100 minus whatever the interest rate is. Obviously, there's an inverse relationship because if it's 100 minus the interest rate, if the interest rate rises, right? If the interest rate rises, then this index will fall, so they're inversely related. So it's easy to keep that in mind. It's like the treasuries that we trade. There's this inverse relationship between interest rates and the price of bonds, so it also carries over to this contract. A little bit on the contract specifications. It's really based on a deposit that you would place in a European bank for a 90-day period, and the interest rate that's quoted as the index is really based on that underlying assumption. So when the cash settle takes place in the delivery month, so if you did not reverse your position and the clearinghouse was forced to settle it for you, it would settle it at whatever the LIBOR rate happens to be on that day, and the LIBOR rate would be, you know, the interest rate, right? So the clearinghouse would decide what the LIBOR rate is as quoted by these London banks. They tell you what interest rate they're paying, so you can find it in the newspaper. It's a widely publicized interest rate, and that will be where the futures contract is reversed if, in fact, you don't reverse it yourself. The interest rate that we see in the newspaper and that we discuss, or that I might ask you on the exam, will always be an annualized rate. So whenever we talk about the interest rate, you know, it's 2% per year, it's 6% per year. So this rate here of 6.82 is an annualized rate. So you have to keep in mind that the Eurodollar is only for a 90-day time deposit. So we have to divide that rate by 4 to account for the fact that it's only a quarter of a year, a fourth of a year, to come up with the value of the contract. So if we want to determine, if we have a quote of 93.18 on the index, which is 6.82 interest rate, and we want to determine what discount that implies, or what the value of the contract is, well, we take the total value of the contract, so $1 million, and we subtract the interest rate, and I'll just move 2 decimal points over here. Instead of 0.0682, I've written it as 6.82. Multiply that by 0.25 to account for the fact that it's 90 days, it's a quarter of a year. So if we take $1 million minus 0.25 times 6.82% times $1 million, then we'll get the value of the contract, and it happens in this example to be $982,000. Okay, so that's how you would determine the value of the outstanding value of the contract with this price of 93.18. Yes. Here? Oh, I just moved I moved a couple zeros around here. If you multiply it out, you'll see that that is actually 1 million minus the annualized interest rate divided by 4 times $1 million. Okay, so it's 1 million minus the interest rate divided by 4. Okay, times 1 million. So that's the basics of how the contract works. In terms of calculating a profit or loss, we can go to this example. And as I said, you have the same inverse relationship that you do with bonds or any of the other treasuries. So if you expect interest rates to fall, okay, then you would go long in this contract. Because remember, it's 100 minus the interest rate. So if the interest rate was 5%, then the index would be 95. If you thought the rate was going to fall to 4%, then the index would rise to 96, right? So you would want to go long. So if you expect interest rates to fall, then you go long. If you believe Mr. Snow, who says that short-term interest rates ought to rise, right, then you would sell Eurodollars. Or you might sell treasury bills, which are also a short-term interest rate, if you really believed what he was saying. So in this example, we think rates are going to fall. So I guess we don't believe Mr. Snow. Let's look at the June Eurodollar. Let's suppose the index is 94.05. And so we go long, we buy. If we turn around and sell that same contract a few months later, let's say on January 25th, then we calculate our profit or loss. Well, it's just a question of taking the difference between the buying price and the selling price, which works out to be 51 basis points. 94.56 minus 94.05, that's 51 basis points. Each basis point on Eurodollars is worth 25 bucks. Where does the 25 bucks come from? Anybody tell me? We've talked about it before in class. Why is it 25? Yes.
That's the million divided by 160 multiplied by
90. You're on the right track. Correct. Thank you. Yeah, exactly. 10,000 divided by 4 divided by 100. And if you just think about it this way, the face value of the contract is $1 million, right? So 1% of $1 million is $10,000. That's an annualized rate. But this contract is only for 90 days. So we have to divide by 4. So we divide the 10,000 by 4. That's 1% of $1 million is 10,000. Divide that by 4, we get $2,500. And the way the index is quoted, it's in hundreds, right? So 0.51 is less than 1%. It's a 0.5%. So that works out to 51 times 25 is 1275 minus our brokerage fee is around 1,200 bucks. Okay. So do you follow me there in terms of the calculation? Any questions on that? This is important. Okay. I know a few people came by my office yesterday or Monday. They were wondering how the Eurodollar works. Why is it $25? And how do we calculate the profit and loss? You have to remember it's different than bonds. And I'm not going to ask you where the $25 comes from. You just remember there's $25, and you multiply each basis point by $25. It's pretty straightforward. Okay? Of course, you have to be careful when you answer a question like this to show your work, indicate if you think rates are going one way, what do you do? You have to write that down. Okay? We can't guess. You write it down. You think rates are going this direction. You take a following position. You buy or you sell. Then you reverse your position. Factor in the brokerage fee, and it's home from there. Okay? I'll ask you a few questions like this on the midterm, as I did last year. So you're satisfied now with the Eurodollar? All right, that's fine. Let's talk about Japanese yen. Some of you were asking me about yen yesterday. Hopefully you've been looking at the currency markets, given the emails I've been sending you with regard to our president's swing through Asia and so on. The dollar is taking a beating again today. Okay, it was down today. The euro's up, the yen is up, the Canadian dollar is up. Fairly strong movement today. So in the case of yen, the contract size, as you know, is 12.5 million yen. And just be careful when you look in the Wall Street Journal, they moved the decimal point over too. If you look on last year's midterm, you'll see an example where I actually take the prices out of the Wall Street Journal, and you have to move that decimal place 2 places. Because the yen right now, there's slightly more than 100 yen per dollar. Okay, I forget what it is. It's 108 or 109. Which means that it costs around 1 cent per yen, roughly speaking. So keep that in mind. The price of a yen is about 1 cent, right? Close to 0.01. It's a little bit less than that right now. So if you think the dollar is going to decline, then you would go long in yen. I know this is a point of confusion. Some people were asking about this based on the quiz. But remember, with any foreign currency in the futures market, as we learned on the video, the quote is dollars per foreign currency. Okay? Somebody was a little confused on the quiz because I wrote euros per dollar as the price that you reverse your position. But all you do is you divide one by the other to get dollars per euro or dollars per yen. So the price is always dollars per foreign currency. So it's always dollars per yen. And so if the price here is 0.0104, well, that's just slightly more than 1 cent per yen. That's what it costs you per 1 yen. And if you think the dollar is going to decline in value, so this is what our leaders are encouraging, is a decline in the value of the dollar. In other words, a strengthening of the yen. Then you would buy this contract, you would go long, because if the dollar declines, then the price in dollars is going to rise. 1 yen is going to cost more, right? So this might go up to 0.0134. So the yen costs more than it does here. Here it's slightly more than 1 cent. Here it's 0.013 cents. So the yen's costing more, which means the dollar is weaker. So you have to play with that a little bit. And you can look at, again, last year's midterm to see an example. So you think the dollar is going to decline, you buy at the price of 0.104. Later you sell at 0.0105, okay? You take the price difference, which is dollars per yen, and you multiply by the size of the contract. Again, your price difference is dollars per yen, right? You multiply it by the size of the contract, which is 12.5 million yen. So you have yen in the denominator, yen in the numerator, and that cancels. So your answer will be in dollars, okay? On the quiz, some of you gave me an answer in a foreign currency, but I don't want that. I want the answer in dollars because these contracts are dollars per foreign currency. So if you multiply dollars per yen by yen, you'll get dollars. So remember, we want the answer in dollars. So it's set up that way. That's why you should answer the question according to the way the prices are quoted in the futures market and on the Wall Street Journal. Don't answer the question by giving me yen per dollar. Okay? So if you got 100 and some yen or whatever, then you know it's the inverse of that. So we have our answer, a profit of $1,700. This is how yen works. Both of these examples, I think, were on the midterm last year. Yes, Christy. It's written there. It'll be written there in the Wall Street. I'll give you some prices that look like it's the Wall Street Journal, and you know how to read that up on top. It'll tell you the contract size. So you do not have to memorize 12.5 million yen, okay, or $1 million or whatever the euro is, or etc. Yeah. But review how the Wall Street Journal reports these prices, and you know which contracts I tend to use as examples. I probably won't ask you a question on lumber futures, right? I don't think I've talked about lumber futures in the class, so I wouldn't do that. I'll ask you questions from contracts that I typically bring up in class, okay? Any other questions on the yen? All right, moving right along. Yeah, I'm sorry.
What was Snow's, what was his purpose in trying to devalue the dollar? I knew it was somewhat for export trading, but...
Okay, so the question is, what is Mr. Snow up to? And his boss, George W. Bush, right? Snow was in Asia, a few weeks ago, maybe a month ago. Now he was in Europe making these statements that the market was reacting to. Our president's in Asia. I think he's maybe in Indonesia today. He's in Bangkok, all over the place. Basically, they're putting pressure on Japan and China. Japan, it's the yen. And China, the common name is the yuan, or the renminbi is their currency. Hello. 139? So to answer your question, I don't know what motivates the president or the Treasury Secretary, but we can only guess, right? And what they say is that these currencies are too weak. And one reason they're saying they're too weak is because if you look at U.S. exports minus US imports, this is sometimes called the current account, it's a big negative number, okay? It's about $500 billion. Huge. Which means that we're importing more than we're exporting. And you also know that there are large capital inflows into the US that are supporting this habit of buying more foreign goods than we sell overseas. A large share of the treasuries are purchased by the Bank of Japan, the Bank of China, and European banks. Something like a third of the sales of those treasuries are now picked up by those foreign institutions. So the president is saying we have to solve this problem. This is not sustainable. This accounts for about 5% of US GDP. It's too high. Historically, this is virtually unprecedented, and we can't keep this up, right? Basically, living beyond our means is kind of a lay interpretation of what he's referring to. So that's sort of the macro picture, and that's something that Snow will tell you. And in addition to that, there's a lot of political pressure on the leadership from the manufacturing sector in the US, basically the so-called Rust Belt, that feel it's unfair competition to have to compete with China and Japan when their currencies are, quotes, undervalued. I mean, that's what they're arguing, is that they're undervalued, right? And so some of the manufacturers believe that the US consumer would buy an American car instead of a Japanese car if the yen were stronger. Okay? Because with a weak yen, the price of imports from Japan for the US, we have a strong dollar, so the price of a Japanese car to us is more affordable compared to a situation where the dollar is weaker. As in the video, you know, the guy was sprawled out over that BMW. Same goes with the euro, right? The BMW is more expensive today than it was a year ago because of the change in the exchange rate. The euro strengthened something like 15%. If that's passed through on the price of the car fully, I'm not saying it is, but if it was, then that car would cost 15% more today than it did a year ago, simply because of the currency fluctuation. So the manufacturers are arguing that this is unfair, and they believe that these currencies are undervalued, and if the dollar is driven down, then consumers will switch. Instead of buying a BMW, maybe you'd buy a domestic automobile. Maybe not, but they're hopeful. And as a result, the current account deficit would fall because we'd switch from importing products to buying domestic. So that's sort of the political pressure from the manufacturing sector, is that you will help us if you get the dollar down. And so that's clearly one political motivation. We're going into an election, and there's a lot of China bashing going on. The reason that, as you'll see in the articles that I sent you, the reason that these folks are bashing China is actually the Bank of China has a fixed exchange rate. Okay? It's pegged to the dollar. It's about 8.2 or 8.3 to the dollar. It's fixed, doesn't vary. And as a result of the growth in China's exports, so China does have a trade surplus, unlike us. Japan has a trade surplus, which means that they're getting more foreign currency in. They have a large foreign currency surplus. And so instead of letting their dollar move, it's fixed. Okay, it can't move. Instead of letting I said dollar, instead of letting their yuan increase in value, they're taking those reserves and they're buying U.S. Treasuries with them. That's essentially what the Bank of Japan or Bank of China is doing. The Bank of Japan, as the other article indicates, they're manipulating the currency market by buying U.S. Treasuries as well. And one of the articles points out, it was actually quite a good article, I thought. It's one I sent you yesterday. And the title was, A Snow Job Caused Bush's Currency Gaffes in Asia. Basically, this author, George Malone, is making a lot of fun of Bush and Snow and saying, you know, whatever's motivating them, they don't know what they're doing because it's not as though the yen is floating anyway. We talk about floating currencies, but the truth of the matter is all major central banks intervene in the currency market, as does the U.S. Right? They all try to influence their currency. It's not as though it's completely floating or a complete free market. It depends what the central bank is doing. And the Japanese bank has been aggressively trying to influence the yen. And one reason they don't want the yen to increase in value any more than it has, and it has gone up about 9%, is then imports will become cheaper for Japan and prices will likely fall. And the problem they have now is low prices, deflation, which is low profits. So they don't want any further deflationary pressure. What Bush has run into in Asia is basically a lack of support. The other leaders, you know, from Malaysia, Korea, and so on, have said, no, it's up to the Japanese central bank to determine their own monetary policy. It's up to China's central bank to decide. We're not going to join you in forcing them to reevaluate their currency. Why are they doing that? Are they just supporting their neighbor? Probably not. As is pointed out by Mr. Mellon, in addition, China's economic growth has been very strong. And the strong economic growth has meant China's been importing a lot of products from other Asian neighbors. So right now, Korea and Taiwan are finding that China has become their largest trading partner because China's importing inputs, adding some value through further manufacturing and exporting those products. So it's true that China's exports have grown rapidly, but in addition to that, China's imports have also grown from neighboring countries. So if Bush is successful in forcing China to revalue its currency, then the demand for China's exports will fall. They ought to, which means that China's demand for imports will fall from Korea and Taiwan. If China's economy slows down, it will affect all of their neighbors. And as he points out, it's just sort of the opposite of during the Asian financial crisis, when all these other countries experienced sort of a rapid devaluation, a decline in the value of their currency. At that time, we put pressure on China not to change its fixed exchange rate, and they complied. They didn't change it, which really helped for quick recovery from the Asian financial crisis. So their policy was okay during the financial crisis, but now we're deciding it's not okay. So that's really a summary of what's in these articles. But you know, I can't answer your question. I don't know exactly why they're doing what they're doing. It might be because they want to get the current account deficit down. But you know, as one of the articles points out, a lot of the products we're buying from China we don't produce here anyway. Right? If you look at the products that are coming into the port of Los Angeles from China, container loads full of stuff that we don't produce here. You know, toys for Christmas and children's clothing and all kinds of labor-intensive products. So if we didn't buy them from China, we'd buy them from somewhere else in any case. So one of the authors points out we can't blame China for our current account deficit. But really the big question is what happens the day when the Bank of China and the Bank of Japan decide to stop buying treasuries. Then the dollar could take a mighty plunge, and that would obviously affect the current account deficit, because if the dollar fell in value by 30%, well, then you might think twice about buying that BMW or that new Japanese car, because its price just increased by 30%. Okay? So that's a long-winded answer to your question, but it gave me an opportunity to explain what's in these articles. I'd like you to read them for yourselves. And I think it's very interesting given what we're discussing now in Chapter 4, because it ties together the currency market, the market for treasuries, the interest rate, and also the stock market. And you can trade those, the stock indices, the currencies, and the treasuries. And that's what's going on right now with the Bush and Snow show. Okay? Anybody else like to add a comment? I hope that you've read these articles. You just accept them for what they say. Is nobody going to defend our president? Come on. All right. So getting back to Chapter 4, let me explain a concept in there called interest rate parity. And this has to do with the fact that when you look around the world, we talked a little bit about this on Monday, interest rates vary considerably. Okay? Probably if you checked with the Bank of Afghanistan, you could probably earn 80% on your money if you deposited your money there versus 2% here. Okay? So, but of course you have to convert it into the local currency, right? So suppose that I discovered that by reading the Wall Street Journal today, and I go home and tell my wife, who knows a lot more about this than I do, I go home and tell her that, oh, you know, I've noticed that we can earn 80% on our money in Afghanistan. I think I'm going to convert our funds over and deposit it in the Bank of Afghanistan. How do you suppose she'd react to that? Pardon? She'd say no. Then she would say, you're crazy, you're stupid. Now, why is that a dumb idea? High risk? What's the risk? So there's the political risk. Okay, suppose okay, so I'll accept that. Suppose I said, well, okay, then let's look elsewhere. Oh, look at Australia. I can earn 8% or 10% on my money in Australia and 2% here. Why don't we convert our funds to Australian dollars? Nobody's going to take over Australia, hopefully, right? So how do you think she might respond to that? There's a big gap in interest rates. What, Mary?
Did you say that before that foreigners aren't protected by their banking laws?
So there's some risk because foreigners aren't protected by banking laws. In Afghanistan, they probably don't have banking laws. Australia, they do. So you're not protected if you're not an Australian citizen. But in addition to that, what
would it cost to exchange your money into Australian money?
now or later? Now and later, exactly. That's sort of what I'm getting at, is the currency risk, okay? The currency risk. So as we saw in the video, one important economic factor that affects currencies is interest rate differentials, right? And there's a lot of money flowing from Japan to the US, partly because the interest rate is higher here than it is in Japan, right? But one day that money has to go back. So when they invest here, they have to convert it to US dollars. So they're long US dollars. One day that money has to go back. So there's also this added currency risk. So, you know, in Afghanistan you have the risks you mentioned, but on top of that, there's a very good chance that the currency a year from now is going to be worth, you know, 5% of what it is today, right? as a result, when you look around the world financial markets, these markets are integrated and linked to the extent that forward currency prices ought to reflect interest rate differentials. Okay, that's really what I'm getting at. So when you look at interest rate differentials, there may be an arbitrage opportunity or there may not be an arbitrage opportunity, and it will partly depend on the forward rate on currencies, because what you could do is you could invest in Australia and then hedge your currency risk when you're coming back out. So if you want to park your money there for a year, you could hedge that currency risk. You couldn't do it in Afghanistan, another reason why it's very risky. But we could do it in Europe or Australia or Canada or other large financial centers. So there's something called the interest rate parity condition, and we can check to see if the arbitrage condition holds by looking at rates in two different countries. So here I'll pick two friendly countries, the US and Canada. Okay? So according to this condition, the interest rate in the US should equal the interest rate in Canada plus the spread between the forward and the spot exchange rate. Okay? So if you're getting a much higher interest rate in Canada, that's a good deal, except that when you try to lock in the price of the Canadian dollar forward, if there's a large discount on the price, then when you go to bring your money back to the US, you convert it at that discounted price, well then that apparent differential in interest rates is no longer there. Okay, you sort of follow what I'm saying? If you look at current interest rates, it might look like a heck of a deal. But if you try to lock in the forward price to bring your money back to the US, and that forward exchange rate is heavily discounted, then all of a sudden a 3% or a 5% interest rate gap, say between here and Australia, can disappear due to the price on the forward currency. So that's all this equation is saying. Okay? What it's saying is that in an equilibrium, if these markets are arbitraged, and if you look between Tokyo and New York, or New York and London, or New York and Toronto, or New York and Sydney, they ought to be arbitraged. There are lots of financial firms that do move their funds around internationally to try and take advantage of interest rate spreads, but they're not stupid enough to be unhedged. So they'll also lock in the currency risk, and there may be an arbitrage opportunity there, and if there is, it'll get bid away, just like we discussed in the corn market. And it will get bid away until this equation holds, basically. Okay? So what this equation says is that the differential on the interest rates should reflect the differential on the forward spread. Okay? So let's just plug some numbers in here. So let's suppose on the US T-bill, the short-term rate is 1.91. This example is in the book. That's in Canada. In the US, it's 1.75. Okay? And let's suppose that the spot exchange rate on a Canadian dollar is 62 cents US. And when we look at a futures contract, the price is slightly discounted at 62.37, which doesn't look too bad, right? If there's a spread, so the Canadian interest rate's higher, it's 1.91. So if you had $100 million to park for the next 3 months, you would look at this opportunity. I don't think anybody's going to take over Canada either. Did you see that film? John Candy tries to take over Canada. So there's a spread. So it looks like you can earn more on your money in Toronto, 1.91%. But the interest rate discount might erode that benefit. And we can test that by plugging these numbers into the above arbitrage equation. So we have the US rate, we have the Canadian rate, and then we have the difference between the forward price, which is the futures price, minus the spot divided by the spot. And when we do that, we find that the parity condition does not hold. It does not hold. So the rate in Canada is still higher than the US, even when we adjust for that discounted exchange rate. So if you had $100 million, you ought to move it to Toronto. And if enough people do that, then this arbitrage opportunity will get bid away through either a change in the interest rates or a change in the exchange rate. So that's just another example that illustrates the fact that the world financial markets are highly integrated, whether we're talking treasuries in the major countries, say the G7 countries, we're talking treasuries, or we're talking currencies. As the video indicated, the currency market is the largest market in the world. Total volume of trade is about $1 trillion a day, partly because there's a lot of this going on, where large financial firms are moving their money around to earn the highest possible return and still not incur tremendous risk. Okay, I have one final item I'd like to explain from Chapter 4. And I've already mentioned this a number of times. And it's sort of apparent from our example of the interest rate parity condition. And that is, when we've discussed the cost of carrying charge market and all that, cost of storage, I normally used commodity market examples like the oil market or the soybean market. But it also applies to most of the financials, okay? Because you can store a financial instrument. It's pretty easy. You can store it on your computer. It's electronic nowadays. There's a cost of storage. If you buy a bond, well, you've invested in the bond. Whatever you had to pay for that bond, there's the opportunity cost on those funds. So you could have used that money for something else. So if you buy a bond, you're tying up your funds. So that's the main cost, because the actual physical storage costs are not very high, right? Because it's electronic. It's not like storing oil or storing wheat. And there's not a lot of risk storing these electronically. So that's the largest cost of storage. So if we look at intertemporal prices for, let's say, the bond market, then it ought to adhere to our cost to carry model, right? Which we wrote down in a slightly different fashion on the board the other day. So I'm simplifying a little bit. Basically, the futures price is equal to the spot price plus the cost of storage. Or if we have two different futures months down here, we have the futures for delivery in March is equal to the futures price for delivery in December plus the cost of storage from December to March. Or I'll give you an example that's also in the book. If we look at June Treasury bonds, and they're trading at 97.30, so it's 30 seconds, and we look at September Treasury bonds, and they're trading at 96.29, so the September price is a little bit less than the June price. So we could ask ourselves, does this adhere to the cost to carry? Well, we have to factor in the one positive cost that I mentioned, which is the opportunity cost of your money. But in addition, with a bond, it's paying a coupon or dividend. And that's a negative cost, right? So if you buy a bond in June and you hold it till September and you're planning to, well, in this example, you could actually buy a June futures, take delivery, hold the bond for 3 months, and deliver it on September. So that's one way you could arbitrage it, right? So, so if you check the price of June and Sep, then you want to estimate your cost of holding it. So let's suppose that the interest rate is 2.5%, which is pretty close to today's value. And let's use a bond that's traded on the futures contract. So it's a $100,000 bond, has a coupon rate of 6%. So if the coupon rate is 6%, that's an annualized rate. So if we're holding it for a quarter, which is June to September, right, 90 days, then you would earn $1,500 in terms of the coupon. So the net cost of holding this bond would be the cost of your money, 2.5%. We'll divide it by 4 because we're only holding the bond for a quarter of a year, multiplied by the price that you're paying, and that's the opportunity cost of your funds, minus the dividend, which is $1,500. So it turns out that the opportunity cost of tying up your money in this bond for a quarter of a year is less than $1,500. So actually, your costs of storage are negative because the bond's paying a dividend. And yes, you had to buy it and type your money, so it's actually negative. So that explains why when we compare September to June, actually the September price is below June. So if we look at the actual cost of carry, it's a negative $888. We subtract that from the June price, and it turns out that the price is very close to the September futures. So if we adjust the June contract for the cost of storage, it comes very close to the price of the September contract. Just like if we looked in the corn market and we chose a March contract and a June contract, and we adjusted March for the cost of storage, we'd expect it would be close to June. If there was a large difference, then there's an arbitrage opportunity if the difference is positive. And believe me, in the bond market, if there's an arbitrage opportunity, it won't last very long. So it doesn't surprise me that, so these are numbers I took out of the Wall Street Journal. So this was an actual day in the market. It doesn't surprise me that those prices are almost identical. So just to reiterate, when we look at Chapter 3 and the cost of storage models that we've studied, they also apply to something like the bond market or other financial instruments. You can also hold foreign currencies as well. Okay? Looks like you're anxious to get out of here. Good luck on Friday, and please remember to go to the review session on Thursday.